Hi, everyone. We're going to get started right on time, and then we'll let people trickle in as well. Hi to everyone who's joined us online. For those of you who don't know me, my name is Rebecca Anderson. I'm the Director of Career Services here at the School of Information. And we are really fortunate today to have a partner with Menlo Ventures, to come and talk to us about funding your startup and also how do you evaluate offers from startups. It's something that students work with all the time. So it's great resources and information to have. Should be a really great session, and if you have questions, please ask them. A little bit about our speaker, Sandeep. He joined Menlo Ventures in 2015 and focuses on enterprise investments. Companies in the Menlo portfolio he's involved with include AppDome, Platform 9, Signified, and Unravel Data. Sandeep was most recently with Cisco's corporate business development team working on acquisitions and investments in the cloud, enterprise infrastructure software, and big data analytics. Sandeep was actively involved with Cisco's acquisitions of TailF, MetaCloud, and Memoir Systems, and investments in MapR, Platfora, and Mooksoft. You gotta love tech names. Earlier, Sandeep was an engineer at Texas Instruments R&D unit, where he led projects to build the OpenFlow switch chip, an ultra-low power IoT wireless moat, and 4G LTE small cell networks. Sandeep received a PhD from the University of Texas at Austin and a bachelor's degree from IIT Madras, both in electrical engineering, and an MBA from INSEAD. Thank you. In his spare time, Sandeep likes to travel up and down the Pacific coast with his dog, read fiction, and drink burgundies, my kind of spare time activity. And with that, I'm going to let Sandeep take it away. Thanks.
Super excited to be here. My name is Sandeep, and I'd just like to do a quick poll of the room here. How many of you are sort of super quantitative, and how many would you say that we're not very quantitative? And we'll go from there. It's just a way for me to utilize my time wisely as we go through the slides here. So super quantitative, who's going to raise their hands and say, all right? All right. Somebody who's familiar with senior level or junior level probability theory even now? Oh, there we go. Awesome. 50-50. So we'll just adjust for everybody. All right. So the talk is, the reason I ask is because the talk is titled Power Law Returns in Venture Capital. And I just want to make sure that we go over what power law means for a couple minutes before we dive into how that impacts how firms like ours think about allocating capital into startups, and therefore how you should think about either raising capital from a venture capitalist for your own company or joining a company which might be funded by a venture capitalist. So what are we looking for from the teams that we fund either directly or that our portfolio company leaders, the CEOs and the VPs of product and engineering and sales and marketing are recruiting for the first or second or third layer in the organization below them, right? Does that help? And in terms of format, please feel free to stop and ask questions at any point of time. We're going to keep it informal, and just raise your hand and we'll get to you. There's somebody with a mic here. Awesome. So like I said, there's three big chunks of this talk. One is, hey, what is the venture investors framework? How do I and my partners think about evaluating companies, and what are we actually looking to do with the money that we've been endowed with to invest on behalf of our investors who are the limited partners in the firm? And then what does it mean to, for you as an entrepreneur to build a company or to actually work for a company, who's sort of fairly early stage? Sound good? Awesome. Okay, great. So let's start off with what is a power law and why we care so much about power laws as investors. So it turns out that power laws are really unintuitive. Can anybody tell me what the green line is and what the blue line is? Which is a power law, which is a normal distribution? Anybody? Sure. Oh, there you go. Awesome. So in this particular case, yeah, exactly. The blue line is a normal distribution, and the green line is a power law. Normal distributions happen pretty frequently, whenever you have averages, right? Like, everywhere you're graded on a curve, and that curve is typically a normal distribution because the professor is trying to determine, like, hey, who are like the top 5% students, who are the bottom 5%, and who are the guys sort of in the big middle, right? Like, that's kind of how grades are distributed. And it turns out that there's some sort of mathematical formula that describes how a power law looks like and how a normal distribution looks like. So the only thing I'd draw your attention to here is that, if you look at, let's see. All right, so if you look at the exponent term in a normal distribution, it's like e to the minus x squared, right, where x is this x-axis, obviously. What that means is that the curve falls off super fast. It's like not just exponent, but it's like e to the power x squared. So it's like falling off really quickly, right? On the other hand, the power law curve is x to the minus alpha, where alpha is usually a term which is bigger than 1. So it's like 1 over x, or 1 over x squared, or 1 over x cubed, whatever it is. And that's obviously falling off a lot slower than the exponent curve, right? What does that mean? What that means is that, look, like, let's suppose that we create some terminology here, and we say, look, the first part is the head of the curve. Like, so this chunk, let's call that the head. This, let's call it the middle, and the rest of it, we call it the tail. What happens is that you see that the highest probability, like, so the y-axis is how likely an outcome am I going to get if I toss a coin with, or spin a die with this probability distribution. With a normal distribution, the most likely outcomes are in the middle, basically, right? And in a power law distribution, the most likely outcomes are in the head, right? But if you look at the tail, it turns out that the normal distribution tapers off really quickly in the tail, whereas the power law distribution sticks around for quite a while and continues to be non-zero, or reasonably away from zero, and it sort of doesn't fall off as quickly as we just talked about. So there you go. So power law probability distributions have heavy tails, and normal distributions have exponentially decaying tails, so that's super fast, whereas power law distributions have the highest frequency, so they're most likely at the head. Okay, and normal distributions are most likely at the middle, right? So if you have to sort of take this away, what does it mean? If there's one thing that the rest of the talk, that informs the rest of the talk, is the idea that averages in normal distributions are dominated by most likely events, which occur in the middle of the hump. So most likely events are a good proxy, or a good way to estimate what the average is for a normal distribution. But for a power law distribution, actually, tail events dominate the average. So what that means is that if you looked at a phenomenon that is happening with a power law distribution, the likely outcome is probably not a great proxy for what the average is likely to be. So outliers, like super performers, tend to dominate the average in power law distributions. Now, there you go. Average equals most likely outcome for a normal distribution, but average equals extremely likely outcome, ideal, like by and large, or very close to extremely likely outcome for a power law distribution. Now, it turns out that many systems, right, where there's preferential attachment, and the definition of preferential attachment is the rich get richer, or winners continue to win and attract other winners, right? Systems like that tend to be naturally power law. Okay, it is certainly true that the distribution of wealth in any country in the world follows power law distribution. Okay, but it turns out that it works for sort of last names as well. Okay, so you can think about it this way, that more Smith boys end up marrying more girls, and so they have sort of more Smith children, and so the distribution of Smiths increases compared to that of the other last names in whatever Anglo-Saxon country this distribution is culled from. It certainly works the same way for cities. The largest cities tend to attract smarter people, more capital, more government influence, all of that. And so larger cities tend to attract more people, and so they get larger in turn. And so the distribution of city sizes is power law. The distribution of people in a social network is power law. More popular people get followed by more people in Instagram, or meet more friends on Facebook, or it turns out actually date more people in college. And it turns out that it's exactly the same reason why successful startups grow easier as well. And so startups, like the size and the success of startups, also follows a power law. Right? And so this is actual data collected from a friendly firm. They're called Correlation Ventures, and they're a extremely data-driven early stage venture investor, and they've tracked how their seed portfolio, and they typically invest at the seed stage, so they get to collect this data over the entire lifetime of companies. And so they've tracked how their portfolio has performed. And what they've seen is that if on the x-axis you draw basically the gross realized multiple, so gross realized multiple means, let's suppose I invest $1. If I get $5 back for my chunk of equity in the company after the company is sold or becomes a public company, I realize a 5x return. In some cases, there are investments that completely knock stuff out of the park, and then you've got a 50x return. You can think about companies like Airbnb or Uber or Instagram or Facebook generating returns like that. And then there's a huge chunk. We talked about the most likely outcome in a power law distribution, being at the head of the distribution. This is like totally what this graph shows as well, that 62% of their investments did not return the dollars that they put into it, right? So this is an extremely risky category, and over half of their investments turned out to be duds. But they've got a small fraction that returned way more than 10x, and certainly a very tiny fraction that returned more than 0.50x of that fund. So, and we talked about preferential attachment systems that create power law distributions. And this is a classic case of a preferential attachment system because successful companies find it way easier to raise capital. Okay, they are way easier to attract talent because everybody wants to go work for the next amazing hot company. And people recruit their friends and they say, hey, look, I'm running engineering, or I'm like a director of engineering at this company, and dude, you should come and work here because you'll be rich and you'll make money. That's what the sales guys say. That's what the data scientists say. That's what the marketing team says. So it's super easy for them to attract talent, and if you attract good talent, in turn, I get to hear about it as a venture capitalist from my friends who say, hey, look, Sandeep, I was very happy at Google or Facebook or wherever, but I'm going to give up my $500,000 a year job because I've decided to take a 70% pay cut and go work for the startup. To me, that's the strongest signal that this company is doing amazingly, because I was like, holy shit, he's giving up more than half of his salary, so the equity must be really worth it, and he must really see the upside there. And so it's easy for companies like that to attract capital and actually attract customers as well. It's easier. There used to be a saying in enterprise tech that nobody ever got fired for buying IBM, right? And the reason for that, it simply is that, imagine you're the head of IT at, a modestly sized company, anywhere in the world, and you're going to place a bet that all of your company's IT systems, the stuff that keeps things up and running, is going to move from one vendor to another. You're obviously going to go with the vendor that has been tested and tried, and there are references, and other people feel comfortable about using it. So they attract more customers, they attract more users, and that's the reason why company growth and therefore venture returns tend to be power law as well. Right? Any questions at this point? Thoughts? I'll move on. So what does that mean? So if you assume that company returns to venture funds are power law distributed, how do we think about constructing our portfolios, right? So let's recap. the consequence of the power law is that the one outlier is going to dominate the average, right? What that means is that the most likely outcome is probably not going to determine what the average return of a portfolio of investments is going to look like. On the other hand, if you're constantly shooting for this one outlier, we've got to believe that one of those bets, so you're swinging for the fences because you're hoping that one of those bets is going to pan out and is going to, quote unquote, return either the entire fund. So if I have a $100 million fund, that one investment is going to make us $100 million, right? Or a huge chunk of the fund, basically. So maybe $50 million, and maybe we'll have 2 or 3 of those, right? That's kind of what we're hoping. So let's actually do the math, using what might be a typical sort of small-sized fund in the Valley, but I think in the rest of the world, we'd actually call it a big fund, a $100 million fund. And in the Valley, people throw around $100 million like, it's peanuts. But a typical $100 million fund kind of looks like this. You have about 3 investment professionals, guys that are scouting, establishing relationships, getting into deals, working with entrepreneurs, sitting on boards or advising the companies, and sort of seeing the company through its infancy, through the exit of the investment. So there's about 3 of those people. And the way it tends to work is that these firms tend to do either pre-seeds, so they're like the first check-in, they meet a bunch of hungry entrepreneurs who have an amazing idea with a PowerPoint and hopes and dreams, and you write a $500,000 check. That's typically how that looks like, right? Or you do what's called an institutional seed, where you're writing, I don't know, a $2 million check because you really like what they're doing, or you're saying that, look, if you're raising a $2 million seed round, you have some initial idea of like what the product looks like, and there seems to be early indications that maybe 1 or 2 people actually care about what you're building. At that point, you're raising, I don't know, $1.5 million, $2 million, and this seed venture capital firm is effectively telling you, hey, look, we're going to take half of that seed round. So I'm going to invest $1 million. I'm going to target to own about 7% or 10% of this company, right? And in some cases, these firms will lead Series A's, where they're going to be part of a big $5 million or $7 million sort of Series A round into a company. Usually by that point, the company sort of reasonably coming along. It's not just 2 guys on a PowerPoint deck, but there's actually a product. There's a few people using it, thinking about using it, thinking about paying for it, actually. In some cases, actually paying for it, right? So for a fund like that, you're typically doing about 50 investments because you write a lot of really small $100K, $200K checks as well, and you're writing a few $1 million checks, a few $5 million checks, right? So a 3x return, if you means that the fund has to return $300 million to its own investors. So what does that look like? It means that the fund needs to have one, if you follow the power law, and if you believe that one investment's got to return the fund, what you're ideally targeting for, you're shooting for something like this. You're shooting for one investment to return $100 million, a couple to return something in the $30 million range, 10, 5, 8, whatever that distribution looks like, right? So this is the 0 to 1x, that's the 50% loss ratio, all the way to like 20x, basically, right? Now, this is the amount of funds that come back to the firm, right? So this is not actually what the company is sold for or what the company IPOs for. If you're targeting, I don't know, 10%, 15% ownership, you're actually looking at something that sells for $700, $800 to $1 billion, basically, right? And big, nice companies, are formed, with and have exited with numbers which are similar to that, right? So you're looking, so a firm like that is targeting an exit, anywhere in the, I don't know, $300 to $800 million range, and if they can't be convinced that going in that, look, this is an idea that if everything goes right, if everything goes right, if this idea can't be sold for, I don't know, $700 million, it's probably not worth their time, right? Because they're acutely aware of this, basically, which is that one outlier investment has to return the fund, so every time you're kind of shooting for the fences. That math carries over when you've got a medium-sized venture capital firm. So a mid-sized partnership is $300 million. Our fund, for instance, is $400 million, the main fund. And so what we're looking for, the bar is 3x bigger. So what we're looking for is that we're looking for, a few $300 million returns to the fund. And, if we're targeting something like, 20% ownership or 15% ownership, that means that we better believe that one of the 20 or so deals that a fund like this would do, will actually return $2 billion or more. And that's when you're getting into the category of like a Box or an Instagram, and you're also hoping that you have a few which are pretty darn close, so which are in like the $500 to $700 million range, right? The stakes are even harder and even higher for bigger firms. So there are some firms who've raised $1 billion fund. Okay, for them to return an investment like that, they, and these firms are big. These are multi-geographic, multi-partner, multi-tier firms, and they kind of operate like a federal system of small partnerships who all sort of roll up to the same fund, and even assuming that they have about 12 partners and doing about 50 deals, they still are subject to the power law. And for them, again, they have to find like one investment that has to return $1 billion. And so again, if you're targeting 20% to 25% ownership, it means that they better have one investment that is $5 billion or larger. And so they are really gunning. For them, having a unicorn in the portfolio is not enough. You better have more than one or two. But they're actually looking at a return for like $5 billion or $10 billion, right? So that's kind of the big framework under which most good venture firms operate. Any questions at this point? It's a lot of data. Yeah, good. Yeah. Great. Yeah. So typically, a fund will deploy capital over the course of 3 years or 4 years, right? So let's divide 50 by 3 or 4. So you have 12 to 15 deals a year, right? Of which you're probably doing 3 Series A's, you're probably doing 6 seeds, and another 6 pre-seeds, right? That's easy. Second question.
At what time do you decide that, in order to get returns, how do you decide whether to sell off something like an Instagram, but persist with something like a Box?
It's a great question. Firstly, there's no right answer to this. Okay. Second, the exit decision is almost always a sort of a unanimous decision between the management of the company and the investors, right? I mean, if you think about it, and I can just talk about myself, for instance, that if I were running a company and it was going okay, it was not spectacular, it was going okay, and I owned, the typical entrepreneur owns about 10% of their company. You're a team of 2 or 3 that start a company. The big founders typically end up owning 25% to 30% of the company. And so each entrepreneur, each founder typically, say, owns 10% of the company. If somebody came and told me, hey, Sandeep, we want to buy your company for $400 million, like $40 million is a lot of money, okay? But it turns out that that's probably not that great, for these guys. It may be okay for these guys, actually. So it turns out that, if you own 25% of a $400 million company, I would look to myself and I would say, hey, look, I own 25% of this company through my fund, and I get to make $100 million. Okay, but selling a company for $400 million is no joke, right? So the real answer is that it's usually a combined decision between the investors around the table as well as the entrepreneurs, and you decide what is right for the entrepreneur, what is right for the investors. It's a board decision. Yeah.
Does that mean that, well, this like if you are getting, as an entrepreneur, if you're getting money from a small venture capital firm, from their perspective in terms of portfolio management, it's hard for them to really add a lot of value and dedicate a lot of time.
And why do you ask that?
Sorry?
And
Because of the ratio of deals with
to partners. Yeah. So the reality is that if you were an entrepreneur and you're raising a seed round, it's typically a syndicate, right? We talked about, let's suppose that somebody is raising a $2 million seed round or a $1 million seed round. You're typically calling 5 such small micro VCs, and you're getting 200K checks from each of them. So it is true that each of them is spending a fifth of the time that a normal investor, a full board member would spend, but you actually do have the attention of 5 guys instead of 1 guy, right?
Sorry, what does 3 times return mean?
So 3 times return means that if I have a fund, if I have raised from my investors a $100 million fund that I'm investing out of, I would like to return $300 million to my investors over the course of 8 years or 9 years or 10 years.
So when you say 100 million, that means if you have like 25% equity, you sell for 100 million.
That's right. And so companies, the example companies over here are kind of sold in that range, basically between 400 and like $700 million. Actually, between 300 and $700 million. And so in that case, the investors themselves got their share was equal to $100 million. Any other questions? Yeah.
large partnership and small VC of like around 50 deals, and only in this size is
Right, and that's a function of how firms operate more than the numbers itself, right? I mean, so the question is, instead of if a $100 million fund is doing 50 deals, why doesn't a $300 million fund do 50 times 350 deals? Well, the primary reason for that is that when you're managing such a large fund, your investors, so my investors, Menlo's investors, for instance, I owe them a fiduciary duty which is way higher than that of a seed firm. And so these investors have to make concentrated bets in a few companies, okay? And these investors are also telling their investors, so they're telling their limited partners in their firms, that look, our firm has a disproportionate advantage in generating outcomes and generating this 3x return, okay, in trying to beat this power law a little bit, okay? Because moving the power law a little bit requires you to actually get to one of these outlier investments. And so you have to, as a firm, generate specialization and understanding of specific markets. And there, it's really incumbent upon you as an investor to sit and add value to your portfolio companies. And so typically, a partner at a fund like ours will probably do 2 investments to 3 investments a year, no more than that. And they're constantly working with their existing portfolio companies, introducing them to better people for recruiting, introducing them to customers, introducing them to other sources of capital, doing all of the things to generate this disproportionate return. Awesome. All right, so let's shift gears now and talk about what's happening today in the markets. So I guess we all understand venture math. So the bottom line of venture math is that each fund is trying to, when they make an investment, they're going in thinking that if everything works out, if all the ducks are in a row, that we're going to return an investment that's roughly the size of our entire fund. Because we're aware of the power law. All right. So what does that mean in the context of where the world is today, right? I don't know if you guys sort of read the news or see what's happening in sort of the world of high finance and interest rates and economics, but effectively, capital is way easier to find than ever before, right? And the reason for that is that the central banks feel that they need to support the economies across the developed world and actually in parts of the developing world as well. And the only way for them to do that is to make sure that interest rates are low so that firms, so companies that raise capital, are not burdened by growth, right? So this is a picture from the New Yorker. Effectively, this is the New Yorker cartoonist thinking about how the Fed actually works, basically. This is them turning on the spigot of the money supply. And the reason for that is because growth has slowed around the world. So China's GDP has kind of flattened out from the heady days, where they were growing at 14% year on year. They're now at, well below 8%. And by the way, it's not just the US that is, easing money supply through low interest rates, but it's also the Bank of England that's easing money supply through low interest rates. So what does that mean? Why am I talking about this, right? So imagine that, you have a 401k, or if you have, we'll get to this later. Imagine you have a 401k or investment or anything like that. A huge chunk of that is allocated towards debt, be it, treasuries, which is sovereign debt, or it's corporate bonds, and the rest of it is in equities, in public markets, mutual funds, et cetera, right? Now, in a low interest market, it's very hard for your mutual fund manager, your asset manager, to return a lot of interest, to give you good yields by just allocating capital towards less risky assets, right? Because, so what's happening is that all of these guys who traditionally manage money for retail investors, you and me, our families, or for endowments like universities and nonprofits and churches and cities even, right? These guys, so mutual funds, hedge funds, in some cases, people managing capital for entire countries, like the government of Singapore has a sovereign wealth fund called Temasek. The government of Norway has a huge sovereign wealth fund. The government of Kuwait and Saudi Arabia have sovereign wealth funds where they're effectively managing capital on behalf of the citizens of those countries. It's like the super large mutual funds is probably a good way to think about them. All these guys are driving money into the venture ecosystem because making yields, because doing a return by lending money to sovereign wealth, in government bonds or corporate bonds isn't going to cut it and is not going to give you the kind of 6%, 7%, 8% combined yield that you're looking from your asset, right? So what are they doing? They're all driving money into the venture ecosystem. So they're coming in and playing where I play, right? Now, what that means is that we talked about 3x returns for venture funds. That's a top decile fund will typically target a 3x return, right? I mean, the best firms in the Valley have 5x. I mean, not consistently, but they certainly have funds which are 5x or 7x. Again, that's when you have like a crazy investment like Uber or WhatsApp or whatever, right? But even otherwise, a good firm, in the Valley will try to peg themselves at a 3x return, which kind of looks like a 30% rate of return, right? But these investors, the mutual funds, hedge funds, et cetera, they don't target 30% returns. They're targeting, I got to do better than the S&P 500 and do it with slightly lower risk. And so they're targeting, 10%, 15%, 20% for the venture part of their investments. Any questions at this point? Yeah, let's assume before taxes at this point. Yeah, before taxes, before management fee, before distribution, before all of those things, right? But the whole point of this exercise is to illustrate that a lot of other people, there's a lot of cash chasing sort of startups today, right? What does that mean? It means that it's easy for a lot of investors to pile in cash into some of these companies, and give them valuations more than I myself might be comfortable with giving them as a venture investor, right? All right, so basically there's more supply for capital, than we had 5 years ago. And the other side of the equation is, what do companies need? What do startups need? Startups need capital for what, right? You need capital for two primary things, okay? You need capital to build stuff, and you need capital to sell stuff to other people, right? All right, so let's see what's happening there, right? It used to be that a typical Silicon Valley company would have to set up a data center and buy, equipment worth $6 million from HP or IBM or Cisco or others to just keep stuff up and running. But thanks to the cloud, that's no longer the case. And so, there's very little capital expense needed today to actually build a minimum viable product. I mean, you can build an app today with 200K, actually with 50K. You can build it over the weekend in some cases, right? And people are doing that. And on the other side, to distribute your product, it's easier than ever because everybody has, one of these, computers in their pocket, and it's so easy to actually ping somebody over the phone, over IM, over social media, irrespective of whether, by the way, it's a consumer product that you're selling or an enterprise product you're selling, the fact that we have mobile, the fact that we have the web, the fact that there is social media makes it easier and cheaper than ever actually to get to early product market fit, right? So what does that mean for investors? For investors, our strategy has shifted, okay? Because we know that we don't want to pay up the big prices, in the later stage rounds where the sovereign wealth funds and where the crossover investors from hedge funds and mutual funds are piling in, our strategy has shifted to either go early, which is, look, thanks to all of this, it takes very little capital to establish early signs of product market fit. So we'd like to go pretty early, and then of those of our investments which are doing super well, we'd like to double down on them and sort of move our averages closer to the outlier, right? Because by doubling down on the winners, we increase our ownership into those unlikely outlier events. That's strategy one. Or you're going big. So which means that if you have conviction that, look, this is the next big Facebook, right? Or the next, Snapchat, let's say, right? You'd see surprising amount of traditional venture capital firms investing at very late stages, even in companies like Snapchat's, because they believe that, look, Snapchat is going to be, $200 billion business or $100 billion business. And so even if you own a very tiny chunk of it, it is likely to be that sort of outlier in my portfolio and therefore return the rest of the fund, right? And what about the rest? We've talked about how everybody's trying to, sort of hit for the, for the fences, but the reality is that the other good thing that investors will do, especially venture capital investors will do, is that we will try to manage the rest by de-risking and by moving the head of the Parla distribution, from 0 to 1x to 1 to 2x. Okay, and we do it for two reasons. So one is that it's always good to, be able to tell, our investors that, look, we did not completely lose capital on this investment. We were kind of thinking about, and we kind of had an idea of what we were doing when we deployed capital into this company. But the better reason, actually, is that it creates great reputation for the firm. If you think about how I find companies because entrepreneurs refer their friends who are other entrepreneurs who are thinking about starting companies to me. And the best way for me to guarantee that I have good deal flow, which is I have access to good entrepreneurs, is by being a good and valuable investor and board member for those companies. And that's the reason why it's very important for good firms to sort of manage the rest. Any questions at this point? No. Yeah.
How do you decide as the winner? Before you decide to double
Right. Yeah, great. So we talked about how systems that create sort of self-attraction, right, tend to be sort of power law systems, right? And the best way for me to know if I should double down on an investment, if my phone starts ringing, or in this case, my text message blows up, and I have like emails and texts from other investors saying, hey, Sandeep, I heard that you invested in company X last year. I'm hearing from my friends that this company is like just executing fantastically, and that they've grown their sales like 7 times in 12 months. Will you let me write a check for the next round? Right? I mean, when I hear that, what I think about is like, yeah, maybe I'll let you write a check, but I would probably like to put a little bit more of my capital behind this company. So we would do over our pro rata when investing in this round.
So you're saying maybe the word of mouth or the buzz on the internet would be a good indicator that this company's doing well, so you wouldn't think about maybe seeing like Snapchat like before they was it really monetizing, or even Uber's like losing money and all this like not as important?
No. Look, I'm already an investor in this company. So I know better than what the media knows whether this company is doing well. So if I believe in the fundamentals of this company, and if I believe this is executing well, and if I have conviction that this is such a large potential market, that's when, if there is outside interest, it's a nice sort of validation for me that we're doing very well, because I know then that raising capital is not going to be a problem for this company. And that's how I know that I'll protect myself, from further future dilution, and so I feel very comfortable about doing more than how much I'm supposed to do in every follow-on round for this company, right? So yeah, I mean, it's not just other people talking. I mean, I'm already part of the company, and I see how the entrepreneurs operate. I see how the immediate team looks like. I see who they're recruiting, and all of that gives me conviction that, hey, look, this feels like this is going to be a winner. Is this an exact science? Heck no. I mean, there are companies which kind of falter in the middle, and investors kind of lose faith, and they don't double down when they should double down. But equally, there are companies which do amazingly the first few years, and then like things taper off. And so I might have doubled down at this point when it was on this amazing inflection, but then it's like, oh, well, this is probably not one where we should have doubled down on. Yes?
How do you make a decision to cut your losses and come out?
Right, that's a great question. So managing the rest typically means that you have to find a home for the investment, right? And finding a home means one of two things. Ideally, you're looking to sell the company to somebody, right? And this is where firm specialization helps, because if you understand a market really well, you very likely know the bankers involved in that market. You know the executives and the companies who are likely acquirers of your portfolio company, and you're effectively guiding them towards a sale. That's one, right? In the very worst case, you're folding the company down completely, right? And, I've done that. Every investor has done that. And the way you do that is like, you try to execute an orderly wind down. And the definition of an orderly wind down is you give everybody in the company, 2 months notice, 3 months notice, in some cases 4 months notice. And you tell them, hey guys, it's probably okay for you guys to start looking for jobs elsewhere, and let us know. We'll write you good references. It's not the problem with what you were doing. Oftentimes, the market is probably not right, or there's not sufficient demand for whatever it is that you were building, and there's 60% failure rate. So that's perfectly fine. All right. So we're going to segue to the next part of this talk, which is, what does it mean for you as an entrepreneur to raise capital from a fund? All right. Any questions before we go there? Awesome. All right. Great. And by the way, tell me if I should speed up, or if I'm repeating myself at any point of time, to make sure that I'm not. So let's first start with an honest assessment of what is a good company, right? And I'm just going to take an informal poll around the room and ask you. Let's suppose you built a company yourself, right? I'm not saying that everybody has to be an entrepreneur, or you worked for, or you joined an early team of, 3 of your best buddies from high school or college, or starting a company, and a few years down the line, they sold the company for X dollars, right? I'm going to start sort of talking about X as the number, and I'd like you guys to lift your hands up and say, I'd be pretty happy if me and my buddies started a company that got sold for X, right? X is $1 million. Okay, tough crowd. All right. all right. Okay. X is $10 million. There you go. We got a few people. You'll be happy. Yeah. X is $100 million. Yeah. X is $1 billion. Everybody's going to raise their hand, right? Because you're selling a company for $1 billion, right? Yeah, I think the first stage of starting a company, whether you raise capital from a venture capitalist or not, right, is an honest assessment of, hey, what type of business is it that I'm setting out to build, right? And, the reality is that a $10 million exit, a lot of people raised hands. The reality is that a $10 million exit is life-changing for founders, right? If a founder owns anywhere between 10 to 20% of the company, you've made $1 million or $2.5 million, and that's fantastic. Not just that, it's probably pretty good for like the guys that you've immediately recruited to your team as well, right? And what does a $10 million exit look like? We've had seed investments which have exited for $10 million, and they're effectively ideas that are really worthwhile, right? Because even the seed check writer, in their head, they're thinking that if everything goes right, okay, this company is going to potentially exit for $50 to $100 million, right? That's what they're thinking. And so it's got to be an idea that is worthwhile, okay? And it has to be executed reasonably well. It means that, you've built a product that is nice, that people like and want to use. Maybe you've sold a few of these, right? But, somewhere along the line, it kind of did not quite work out, and so you had to sell your company for $10 million. Yeah, what's the question?
What's the average revenue or the monthly?
To be frank with you, it depends is the right answer. In some cases, these companies are at, between $500,000, $1 million in revenue. But the reality is that most people, when they're selling a company for $10 million, the buyer is actually not concerned about revenues as much. The buyer just likes the team and believes that this team has built a product that is so good that I, as the acquirer, will now be able to turn it around and sell it to my existing customers and may make way more than $10 million, right? Like that's what's kind of in their mind. Any other questions? A $100 million exit is life-changing for not just the founders, but it's actually career-changing for everybody else. So if you join your buddy's company and you're employee number 7, 12, even 20, okay, and your company's had a $100 million exit, that means that these founders are likely going to join whatever large company, as a senior vice president or as a vice president, and you've immediately had a leg up in your career, right? So it's actually career changing, not just for the founders, but also for the immediate executive team. A $1 billion business is obviously life changing for founders and most employees, right? But it's actually also career changing for most employees. And a $1 billion idea is a rare, insightful idea, that not just disrupts the status quo, which is why people in Silicon Valley throw around the word disruption, like it's popcorn. Okay, so it has to be a disruptive idea because it has to completely change the industry in which this company operates, but it also has to be executed flawlessly, right? Where, for every dollar in capital that you're raising, you're creating this sort of stream of dollars in the future that you're going to get from your customers by selling your product, right? A $10 billion business, which is super rare, right, is life-changing for everybody in the company, but actually is also life-changing for employees and ecosystem partners. So, if you imagine, for instance, not just Airbnb employees, but the hosts, who host people using Airbnb, it's kind of impacting their lives as well, right? And it's kind of becoming livelihood for them. So that's the that's the quality of an idea, and you obviously have to execute flawlessly to get to a $10 billion sized company. A $100 billion business, this is, we're no longer in startup territory, but we are in, sort of world-changing companies, right? I mean, a $100 billion business is like Facebook or Apple or Google, where you're kind of changing the world and you're creating an industry de novo, right? Like internet search did not exist even as a concept, but now we're so comfortable with it and familiar with it, right? So you create an industry, right? Or personal computers or smartphones did not exist before Apple, at least not very well. And that's what you want. So a $100 billion idea. And so anytime, I have people coming in and telling me that, oh, it's a $1 billion idea or a $10 billion idea, I kind of ask myself and the person on the other side of the table if that's really true, because it's really hard to tell sitting, watching these three guys and their PowerPoint deck that, oh, this is going to be an idea that's going to be the next $1 billion idea or the $10 billion idea. Any questions at this point? So yeah, start with an honest assessment of what you're trying to build. And the thing about entrepreneurship, I think that a lot of, venture investors don't see is that you can build perfectly great companies that get to $100 million, $1 billion valuations without ever taking venture capital money. And that's entirely feasible. Okay, these companies take forever to build up. Okay, I think each of us probably has a story from our hometown where there's an entrepreneur, who started a company 20 years ago, and they've gradually built this company to an amazing company. And that's entirely possible. MailChimp, it's going to do $400 million in revenue this year, so it's probably worth way more than that. They never took venture capital money apart from raising a bit of capital from their friends and a few wealthy people in Atlanta. So it's entirely possible. So yeah, let's start with an honest assessment of what type of business you're setting out to build. And then, through each stage of your company, you're trying to de-risk the things we talked about in advance about, hey, if everything is executed flawlessly, we'll get to this outcome, right? So at each stage, you're thinking about de-risking it, right? So what's the biggest risk, when you're just starting out as an entrepreneur, you're joining this entrepreneur on their journey because you want to partner with them? The biggest risk is team. People argue about, hey, let's say I and my buddy want to start a company. We're trying to decide how the equity should be split amongst ourselves. If I'm trying to recruit this star engineer, or I'm trying to recruit the star sales guy, he and I are having a negotiation, or she and I are having a negotiation about how much equity I should give to them, right? So team is the biggest challenge. And then obviously there's early product market risk. And the way to de-risk it is through teams, is to have mission-driven founders who really see the crystal ball in a way in which even I as a venture investor cannot see. And two, by building good product and technology. To take it to the next level, to build a company with an enterprise value of $100 million is not just good enough to build a good product, but you've got to figure out an amazingly capital-efficient way to sell it, right? So you've got to execute flawlessly on sales and marketing, and you have to build a product that doesn't fall down when people start using it. To go from $100 million to $1 billion, okay, now you're no longer in startup territory. You have to start thinking about, hey, what does the broader financial and investing community think about my company? And for that, okay, you need two things. You need to have specialization within functions. So, my sales team is thinking about expanding out to another country or another continent. That's one. Or two, we used to do marketing in just one way, perhaps through social media, but perhaps it's time to expand it and do email marketing. Perhaps it's time to do trade shows. So you start seeing specializations within each of these functional areas, and at the same time, your engineering team is saying, or your product team is saying, hey, look, we have this one product, which is Act 1 of our company, which is pretty good. Perhaps it's time for us to think about Act 2 as well, right? So that's when somebody like Uber goes and says, yeah, this Uber business of moving people around is pretty good. Maybe we should start planning for delivering perhaps food, right? And by the way, this is also when everybody gets a CFO, because people start looking, hey, growth is no longer enough. You have to grow profitably. How does the business look like? I mean, does it generate cash, or does it just burn cash?
So my question is, so when you're talking about growth for a company, so when you're talking about expansion, you set a timeline and you see the potential in a company, but you say, or I was saying that you need to be probably when you're starting out at $1 million, you need to be, say, about 100 million by in 10 years, or you set a timeline.
Yeah, I mean, we're for most venture investments, we're hoping that the company becomes a huge company within 8 years, ideally, right? Tech investments, in many cases, it takes companies 4 years, 5 years, because it's so much easier thanks to the internet, thanks to social media, thanks to smartphones, for companies to scale rapidly today, right? I mean, it's entirely possible, and it's entirely reasonable to expect companies that take venture capital to set themselves on a timeline where they would reasonably, if everything goes correct, reach $1 billion valuation. If everything works, if the market takes, if you don't screw up execution, to get to $1 billion in valuation at the end of 8 years. And if it doesn't, right? If you see 4 years in or 3 years in that, hey, yeah, this is good, but perhaps it's not going to be $1 billion exit, that's when everybody sits around the table and starts thinking about, hey, when do we exit this investment? What's the best way forward to find a home for the company and exit? Questions? Awesome. And yeah, and going from 1 billion to 10 billion, it's not a startup, so I don't know, quite frankly. Right. Now, it turns out that doing this, like going from a $1 million enterprise value company to a $10 million to a $100 million company is really hard. Okay, this is the graduation rate for startups, so which is startups going from seed funding to Series A to Series B to Series C. Basically what it means is that at every stage, there's a new challenge in getting your company to the next level, right? When you're going from seed to Series A, your big thing is, hey, how do I find the first few customers? From A to B, you're like, hey, how do I make this customer acquisition much more repeatable? How do I attract good talent to my company? From B to C, you're thinking about, how do I get customers profitably? Okay, because I need to start, showing investors and the world that, I can grow and build this business in a very capital efficient manner, and it's going to generate capital at some point of time. And it gets harder and harder as you go down, right? So companies have bar mitzvah moments, basically, roughly 6 months before a fundraise, before the next fundraise. They sit down and they say, wow, this is pretty good. We've been working pretty hard at, executing whatever our strategy has been, but now we've got to tell the next investor 6 months later that, we are going to be good based on whatever they're looking for, and the next investor is looking for profitability, perhaps, or the next investor is looking for scale, depending on where you sit in this sort of 100 million to billion, 10 million to 100 million to $1 billion sort of valuation. Right? Yeah.
The letter relates to the valuation of the previous.
It does not exactly correlate to valuation, but this is a pretty reasonable proxy for order of magnitude. So what does it mean, when you think about raising capital, right? So if you're just starting out, you have an enterprise value between $0 and $1 million, shall we say, And what you're really looking for an investor who's very engaged, who has seen the story before, and who can help you de-risk the things that you want to de-risk. So you want a de-risk team, for instance, in early stage investments. Okay? And so you're looking for super angels, and most super angels or accelerators you will find will focus on, hey, how do I get the team to gel? How do I get this team to build a minimum viable product? Because those are the risks that these guys really know how to de-risk. And so when you think about raising capital from somebody at that stage, you're typically thinking about, raising from a super angel rather than like talking to me about it, quite frankly. Right? If you're raising a seed round, $1 million, $1.5 million, okay, and you're giving up 10% of your company, your enterprise value is roughly in the $10 million range, right? At that point, you're raising capital from micro VCs who've kind of figured out, hey, what does it mean for the product to look nice enough and that the product story to be nice enough so that the first few customers will start biting, and you can sort of create the validation that, look, there is a market for this product. When the entrepreneur showed us this magic crystal ball, it was not completely broken, but there is actually something to the vision that this entrepreneur claims that he has or she has. And going from there, you have the traditional venture capitalists. We typically invest, in companies with enterprise values ranging from, I'll say, $15 million to $200 million. So, 100 million is a really bad sort of order of magnitude number for that. And then there's late stage investors or growth equity guys, and then there's the public market investors who invest in companies at $10 billion, et cetera. Any questions at this point? And the reason why I talk about this is because we saw this. Let's go back. We saw these risks, right? And we saw what you have to do operationally to de-risk it. Each of these investors has ideally built a specialty in being able to manage and handle that risk because they have invested so many times in companies at that particular stage. They have become specialists at solving and recognizing patterns ahead of when the investor himself might see those problems and sort of help the entrepreneur, de-risk that. Does that help? That's right. That's right. Right. So the question is, there's a lot of blue chip companies who have who have venture arms within themselves, and do they compete up and down the capital stack? I used to work for one. So I used to work for Cisco's investments team. And actually, I'd say that the place that we competed the most with were the traditional VCs and the growth equity. And the reason is very simple. A large company, a blue chip that is looking to invest in a company, typically wants to invest in a company because they think it's going to be of strategic value, right? And what does strategic value mean? Strategic value means that the blue chip's customers are going to care about whatever product that this company is building, right? So, and how does the blue chip know that the market is going to care, that their customers are going to care about whatever it is the startup is building? They do it because they're seeing their own customers going and buying products from this startup, right? And at that stage, the startup has had 4 or 5 customers, has had an overlap of customers between the blue chip and the startup, basically, right? So they've reached some amount of traction, and that's typically the stage at which traditional venture capitalists invest, right? It's not an exact science. There's obviously examples one way or the other, but this is typically how it looks like. Questions? So yeah, I mean, the big takeaway is basically that, look, building a business is really hard. Be very candid and honest with yourself about what type of business you're looking to build, how quickly you're willing to build that business. You could build a nice $10 million $50 million, billion-dollar business gradually over a lifetime, but that doesn't work for me as a venture capital investor. And so it should not work for you to come to me, a venture capital investor, and ask for capital for that, right? Have an honest assessment of what your idea is and how you want the company to grow, and then find the right investor at the right stage, because it's very likely that they have seen the patterns, and so they know how to de-risk your company as it grows from one stage to the next. All right, so last piece, we only have 15 minutes left, and we're going to chat about what does it mean to work for a startup like this, right? I mean, so far we've covered two things, right? One is how do I, as a venture investor, think about configuring my portfolio, and so how much conviction do I have at whatever stage that I'm investing in that this is going to be a home run company because of the power law? What does it mean for entrepreneurs when they come to investors and ask for capital? And where do investors get comfortable with risks, and where do investors get comfortable with what they want the return to look like? And then we'll talk about managing your career at a startup. So let's go back and use the same framework of enterprise value, right? So, we talked about the risk, right before Series A, which is, when your enterprise value is anywhere between $1 million and $10 million, order of magnitude, right? The biggest challenge, obviously, is product and market and technology. Hey, who's going to build this? How good is the product going to be once we build it? And will I be able to recruit the next set of people to come and join me? Because building anything big requires a large team, right? And so what you give as an employee of this little company, which is effectively 2 guys, a dog, or 3 or 4 people and a dog and a PowerPoint deck and maybe some code or some prototype. What you give is that you give your excellence, your skill in one of these facets, either product or marketing or technology, okay? And you have the ability to recruit and attract talent, right? That's what you give. What you get is you get meaningful ownership in the company, right? You get 2%, 3% of a company, and you're hoping that, look, one day this company is going to sell for $300 million or $400 million or $1 billion, and my 1% is going to be worth a lot of money, or my 2% or 4% or 5% is going to be worth a lot of money, right? And that's kind of the trade-off that you're thinking about as an early employee. Now, once the startup has raised capital from a good firm, and it's kind of on its way, it's got a few customers, there's early signs of product market fit. What you're giving is you're giving functional excellence in one of these axes, right? Hey, you've built a great sales team before, okay? Or you know how to sell this one particular product in this one particular market. Or you know how to attract leads, or you know how to market, and you're really good at email-based marketing, or you're really good at lead gen using webinars. And that's what this company needs at this stage in their journey, and you're really good at that. So you have functional excellence in this. And you're getting really good equity, like you're probably not at this stage getting 1% of the company, okay? But you have very nice upside, right? And more importantly, you have able to demonstrate not just your skill and to be sort of better at your craft, but you have the ability to demonstrate leadership, because remember, when you're joining a company at this stage, which is, Series A, Series B, what you're hoping is that this company is going to continue to grow. And when it gets to the next stage, where there's functional specialization, you'll be the leader for whatever your function is, right? So the upside you get is you get great career leadership experience as part of your career, in addition to the very nice upside. For a company that's between $100 million and $1 billion, so this is a company that is typically doing anywhere between $10 to $20 million in revenue already, and is going to double or triple or quadruple the next year in revenues. The first set of leadership is already in place. In some cases, the director level of leadership is also in place. But each of the functional specializations are still narrow enough. So there might be a VP of data science there might be a director of data science or maybe 2 or 3 directors of data science, but they're still looking for really sharp data scientists who have some experience to join the team. And that traditionally has been in the Valley the best place to start a career, right? If you have the skills, but you haven't demonstrated the skills before, it's a good place for you to make the trade-off. What you give, you say, hey, look, I'm smart and hungry, and I'll work hard, and I'm really sharp, and I'm really good at what I do. I get to rapidly demonstrate skills. People write on their LinkedIn profiles that I grew sales for my territory from $2 million to $6 million. That's fantastic. I mean, that's like a sales job out of school, right? Or you say that, I was responsible for analyzing this massive cohort of data, and thanks to my efforts, I was able to create this data product, and that's super valuable, right? Or if you're an engineer, you say, I took ownership for one small feature within what we were doing, and I executed flawlessly, and we built this, and that led us to win 3, 4, 5 customers, right? So you get to rapidly demonstrate skills, but more importantly, you actually build your network, right? What that means is that, you've now worked for people who are really good. Ideally, you've worked for people, who are functionally excellent in any one of these domains, which is why the company was able to grow from $10 million to $100 million in enterprise value. So these guys have proven that they can actually execute, they can hold their end of the bargain. And so if you're working for people like that, it's actually pretty good for your career because, these people become your network for life, right? Well, for $1 billion to $10 billion, I don't know, it's no longer a startup. Right. Any questions at this point? All right. So, we're pretty much at the end. I mean, this is, well, everybody knows who this is, but the idea is that, power laws dominate, venture returns, but they also actually dominate how people succeed in their careers, just because, these are systems where winners attract winners, and where more popular people become more popular, and the wealthy attract wealth, and so on and so forth. And so, our framework, and I hope your framework, if you're interested in startups, and not everybody has to be, right, is that you gotta play to actually swing for the fences, and so you want to make sure that striking out is going to happen, right? 66% of investments return between 0 and 1. The head of the power law is between 0 and 1, so it's very likely that you're actually going to lose. But this is the reason why, I stress not just the financial upside, but also the longer term sort of accrual, not just of wealth, but of skills, of network, of other things that you gain, by joining the right company at the right stage, in the startup's journey and in your career journey, right? So, yeah, that's about it for me. I mean, we've got about 5 minutes left. I'm happy to answer any questions. I think this and this and this. Yeah.
Pass around for this part.
Yeah, I was wondering if you can comment us a little bit from the point of view of the venture capital. How's the business model? Do you invest money of yourself? How you raise money from investor, and how much do you charge? Is an annual administration fee, exit fees, or
Sure.
how it works?
Sure. I mean, you can actually look it up. It's pretty standard across the Valley. I can't speak specifically about my firm, but I can talk about what the average is. It's very common for a venture capital fund to raise, I would say, over 98% of its capital from other investors, with the partners in the firm contributing between 1% or 2% of it, right? In some cases, a little more if the partners are wealthy and they really want to, they're saying, hey, look, we're spending our time doing this, so we might as well put more of our money in it. That happens. But that's the target typically. And the average management fee it's called 2 and 20. You can look it up on Wikipedia. It means that you're charging 2% every year over the lifetime of the fund, and the lifetime of the fund is 8 years or 10 years. And you're making 20% of the upside.
You talked a little bit about, I guess, job applicants for when they're looking at startups. If you want to be an employee of a startup, then your career is also on a par law, where if you go to the right company, then your career becomes better, and then you go to the next great company, so on and so forth.
Because the guys that have worked with you, the people that have worked with you before, they'll say, "Hey, look, I'm at this really great company, and we're gonna make a lot of money. Come on over."
So my question is, ex post, it's easier to comment on it and then say, "Hey, this guy's career made because of this company."
Right.
But before you make the decision, how would you, even if you have a lot of indicators that show you, great VCs invested in this company has a lot of buzz in, TechCrunch or whatever, enterprise value at the right sweet spot. How do you distinguish between those that are going to do well, hopefully, and kind of de-risk that for an employee, and from those that are kind of hyped up?
So the question is, the numbers might all be there. The company might have the right buzz, it might have the right set of investors, all of this. How do you know whether you should join this company, right? So the truth is that, and true for me, myself in my career, is that, the financial rewards are very important, right? But fundamentally, you should only spend your time or your capital in things where you think you can make a difference, right? And so the decision-making process is, hey, am I really passionate about it apart from just the financial monetary return? Do I like the people that I'm working with? And second, you've got to believe that I, as an individual, can push the outcome, towards the outlier in the power law, right? If you can't believe that, or if the people that you're immediately working with don't believe that, then that's not going to happen, right? So the decision-making framework is, am I passionate about this? Are the people that I'm working around, are they passionate about this? The people who are hiring me, are they passionate about this? And 3, do I actually enjoy their company? Because you're right, 50% of the times it's actually not going to work out. You are going to spend your time chasing after, all this effort, spending all this effort, for us, like both effort and capital, working with a company that is not likely to yield anything, okay? But I at least know that I've worked with a great team and this was for a good purpose, and we actually thought going in that this could be a great outcome, right? So you have to believe in the mission for sure, and then you have to be pragmatic about, hey, does this feel like this is the gang of guys and gals that is going to get us there, right?
All right. Just very general questions on what type of team excite you, and what type of startup team turn you down, like the chemistry, the skills.
It's a great question.
Or
So the question is, what kinds of teams excite me, and what kinds of teams don't excite me? And to be frank with you, this is not a Menlo Venture statement. My answer is not the firm's answer, but it's sort of my answer. And every firm has individuals who have slightly different makeups and the kinds of companies that they like to invest in and teams that they like to invest in. I'm an engineer, so I'm biased towards teams that have smart engineers. I like cool stuff. I have to have like a gee whiz moment of, oh wow, I did not know that anybody could build it. It's not just I didn't know that you could build it. I didn't think anybody could build it, right? That's very important for me. But as I get older, the other thing that's really important for me is founders who have a very nuanced appreciation of a particular market, okay? And we see this time and time again, with founders, who probably don't necessarily need to have like the best engineering talent in the world, right? If you think about it, Airbnb started on an Excel sheet. It's not a portfolio company, but it started, on an Excel sheet where they kept track of, who's going to come and rent our little, like mattress, and we're going to give them like cereal, cornflakes in the morning. Or Uber, where you bought a few cars and painted them black and made sure the upholstery was nice, and you wanted to make sure that everybody got like a very cool baller experience, when they stepped into an Uber, right? It doesn't require a lot of technology there, but there the entrepreneurs have this like very acute sense of what the problem is, right? The acute sense of a problem, for Uber is that, when it's 2 in.the.morning and, you're in, whatever, you're just coming out of whatever bar that it is, and you're thinking about how to get home, rather than, disappoint your date by like having to flag a taxi like 20 times, you're actually impressing her by saying, hey, you know what, like I can just summon a cab by pressing this button, right? Or Airbnb. And that's like a acute understanding, of how of consumer psychology, right? That's for a consumer company, but there are enterprise companies where, their founders will walk into your room and they'll describe a problem with such precision. And they'll talk about why it is that the buyer is going to pay, write a $10 million check, when they're buying this product, whichever large customer it is, right? They say, you know what, Walmart's going to pay us $2 million, and this is why. And then they'll walk you through the chain of reasoning. It's not hand-wavy. They know exactly who it is, the person that is going to write a $2 million check for their company and why they will write that check. Like, I mean, that sort of market insight is like just tremendous. So I would say those are 2 things I look for. Great engineering, gee whiz, I didn't know you could build it. And wow, I had no idea that people were willing to pay for this, right? Market insight.
So unfortunately, our last question.
Okay. So coming from the perspective of maybe someone who's building something from the ground up.
Yep.
Like how much do you need to have to like present or to ask for a meeting with a VC, or how much do you need to like prepare?
I mean, let's go back. It depends on who the investor is, right? It depends on who the investor is, right? So if you're looking at this stage, right, just starting from the ground up, you need to have enough conviction that this is going to be a $5 million, $10 million company. That's it, right? Because it's sufficient.
1 million is, for me,
not enough. No, that's great. So then you have conviction that it's going to be worth $10 million or $100 million, right? But even then, the bar for convincing a venture investor when you have nothing except just your dreams and your PowerPoint deck is super hard. But if you have a product, right? If you've demonstrated early product market fit, then investors down the stack are more comfortable because they can see this product, okay, and they can see the demand for this product and imagine that, oh, wow, I feel like this is going to be a $100 million return to my fund when I invest in it, right? But oftentimes that is not the case because it's really hard, as we talked about, to go and sell your company for $400 million. It doesn't happen that often, It shows up on the Wall Street Journal when that happens, right? So it's really hard, I would say, when you have under $1 million in sales, or no, I wouldn't say that, but you haven't even sold anything, or you haven't magically gotten 100,000 users or something like that. It's very hard to convince a traditional VC that, wow, this is going to be an outcome that is so big that it's worth swinging for the fences for that investor. And so you're actually much better off raising capital from micro VC firms or from angel or from accelerators like Y Combinator, right?
All right, please join me, everyone, in thanking Sandeep, and we can have some conversation afterwards.
Thanks, guys.